Shana Sissel. And ladies, I'd like to begin the conversation with news from just about an hour and a half ago, 2 hours ago. The New York Fed, U.S. household debt has for the first time ever crossed $16 trillion with the T. And a big driver was credit card debt, up $46 billion from the quarter past, $100 billion or 13% from just a year ago. There were 233 million new accounts open last quarter. Here's the thing, serious delinquencies. This is a little bit of an issue because mortgage went higher, home equity lines went higher, auto loans went higher, credit card debt went higher. The only thing that was down was student loans. So we're starting to see delinquencies also creep up here. And so, Sarah, let me start with you. In this sort of circumstance, how can consumers keep powering this economy?
You know, they don't really have a choice but to spend, right? Nothing's free around here. And so, you know, people are working longer hours. They're running up credit card debt. They're borrowing, right? And it's not a great situation. But until there's a fix for this economy, it's kind of the new normal. And so, you know, what you are seeing is a shift away from, you know, kind of discretionary spend and into essential spend, where they're getting hammered with gas prices, with food prices that just keep going up.
So, Shana, should we be concerned with again, maybe these are low-ish in the grand scheme of things, but they're definitely moving in the wrong direction with all these delinquencies?
They definitely are, but keep in mind, the delinquency rate has moved back to what it was pre-pandemic. So it's not overly concerning right now. The U.S. Census Bureau did a survey earlier this month, surveying households about their difficulty in meeting household expenses. And in lower income neighborhoods and lower income zip codes, they found that more than 40% said that they are having somewhat difficult or great difficulty meeting their household expenses. That's definitely a concern. But we have to remember that inflation plays a big part in that. And so as we're starting to see inflation come down a little, most obviously in gas prices, where they're finally under $5 here in the Chicagoland area. This is a positive. It is definitely something I'd want to keep my eye on, but they're still at relatively low rates. And so I'm not overly concerned just yet because credit quality all along has been quite high.
All right. So here's the thing, Sarah. Auto debt, I checked that out, up $87 billion quarter to quarter. And it's close to taking over student debt as the #1 debt outside of mortgages. But I'm bringing it up because last time you were with us, you gave us Ford. Fantastic. You know, listen, the stock has been on fire since then. In this environment, though, and knowing that these delinquency rates are going up, do you stick with a stock like that?
You know, I like the auto sector. You know, a report just came out from Q1 saying that there's still a ton of pent up demand for cars, right? Remember a couple of years ago when you could not get your hands on a new one? And the reality is cars have been expensive for a while. The average price of a used car in America is $20,000. The average price of a new car, $30,000. These are expensive purchases. But despite the rising gas prices and inflation, I think that auto stocks that are trading at modest EPS and have low market caps continue to have growth potential. What I wouldn't touch right now are some of those very, very, very expensive, you know, electric vehicle stocks that shall not be named.
All right. Hey, Shana, a moment ago, Loretta Mester made some comments that knocked the stuffing out of the market. And we got two more Fed speakers today, and it feels like they're in cleanup an aisle pal, right? You know, you had Neil Kashkari over the weekend. Seems like they're trying to clean up his comments and make us more worried. I mean, what do you think the Fed is seeing now, just so far this week with the economic data that's come out?
Well, I think that the Fed is seeing that the economy is actually holding up quite well. Yes, there is some weakness in manufacturing, but we are seeing positive increases in durable good orders. Personal income was better than expected. Retail sales remain relatively strong. So the consumer is still spending. Yes, as Ed pointed out earlier, they're spending more on services than goods, but they are spending. And so the Fed is saying that the demand is still higher than they would like it to be, and they want people to be aware that they don't want to do, and I think this is what some of these Fed presidents are trying to warn, what they did in the 70s with this constant raising and cutting rates, which just led to great volatility, and it never really addressed inflation.
Right.
I think they want to see inflation stay low for a period of time before they would even consider start cutting rates again.
All right, so I'm asking all the guests today about this July bounce, and do you fade it? Do you keep buying? Shana, let me stay with you. Are you buying in this environment, or did you take some chips off the table?
I'm always a buyer on weakness. I don't try to pick bottoms. I don't try to figure out if it, it will get weaker. But if I have names that I like and they're at prices that I think are attractive, I'm going to be a buyer in these types of markets.
Sarah, you've had ideas the last few times you've come on. Anything new, or again, you're sticking with the names like the Fords?
I'm keeping an eye on travel. As the summer season winds down, I think we're going to be, find out, are people traveling for businesses and conferences again, or are people broke and done with revenge travel, right? Are people going to travel through the holiday season? People move during the pandemic. Are they going to go back and see their old friends, right? And so I think Airbnb reporting later today is a huge bellwether here, right? With the added bonus that it's a company that actually generates revenue for people, much needed cash, by letting them rent out their places while they travel. So those are the kinds of names that I'm just starting to pay a lot more attention to. All
right. By the way, we got Mark Mahaney coming next also to talk about that. And for full disclosure, my subscribers on it, I got less than a minute to go. Sarah, Shana, you liked the energy names. I know Oxy, NOV, you liked also. You still like them here. They're starting to struggle a little bit, the oil patch.
I do like Oxy right here. The 18% stake from Berkshire is definitely attractive, but I'm most interested in some of the chip names right now with the recent passage of the CHIP Act and how beaten up they've been. I'm starting to nibble at those names. I really like Marvel because it's not consumer sensitive. And as you know, I'm just a big fan of NVIDIA. I know it's trading at a premium to the market, but it always trades at a premium in the market. It's an innovative company. It's getting a lot of growth out of data centers. So that's a name that I really like. And Marvel's another one.
Yeah, it's hard not to like NVIDIA at any price, especially on sale. Ladies, Sarah, Shana, thank you both very much. Great stuff. All right, coming up, my next guest says now is not the time to get negative on equities. By the way, he told folks that on July 1st, ahead of one of the best Julys ever. Now, what does Michael Darter think? He's next on Set.